Welcome back to the Deep Dive. Today we're digging into the Q3 2025 performance for a major consumer goods player. We've got the earnings report, the call transcripts. We're going deep.
And on the face of it, the numbers look, well, fantastic. Organic sales up 3.4%, adjusted EPS hitting $0.81, both definitely beating the street's expectations.
Right. But that's where it gets interesting, isn't it? Because the company itself, they're talking about a tough environment, a mixed consumer backdrop.
Exactly. That's the paradox we want to unpack. Their main categories, growing maybe 2%, slow, consistent with Q2, but slow.
So the big question for us and for you listening is how? How did they pull off almost 3.5% organic growth when things are so, well, sluggish?
Yeah, where did that extra growth come from? What's the strategy?
And it seems, looking through the sources, it boils down to this really clever balancing act. They didn't just bet on high end, they didn't just go all in on low end.
No, they somehow managed to push both. Value brands for staples, everyday stuff, and at the same time, these high-growth premium innovations.
Okay, let's set the scene first. What does this mixed consumer backdrop actually look like?
Well, management laid out a complex picture. You've got high borrowing costs, definitely. Rising delinquencies are starting to bite.
Affecting discretionary spending, I assume? Cars, bigger purchases?
Exactly. Housing, appliances, that kind of thing. That pressure is definitely there. But on the flip side, unemployment is still relatively low.
So people have jobs, they have income.
They do, but they're getting really, really careful about where that money goes, much more selective.
You can see that playing out in the grocery aisles.
Right.
Especially with staples.
Oh, absolutely. The most telling example, I think, from the transcripts was laundry detergent. It's fascinating.
What happened there?
Well, for like 8 straight quarters, the value end of the laundry market, it was flat. Or even shrinking. People were actually trading up.
Buying the fancier stuff, the pods.
Right. But that trend, it slipped into reverse in Q3. For the first time in 2 years, the basic value tier of laundry detergent actually saw positive consumption growth.
Wow. Okay, so that's a clear signal. People are trading down for the basics.
Undeniably. And get this, those expensive pods, the ones that cost maybe twice as much as liquid, flat. Been flat for 6 quarters now.
So consumers have made a choice there. Value is back for laundry.
It seems so.
So if everyone's hunting for value, how does this company play that without just, slashing prices and killing their margins?
That's where one of their core assets comes in, the Arm Hammer brand.
The old reliable.
Exactly. They launched this new campaign, Give It the Whole Darn Arm, leaning right into trust, reliability, especially important when people feel financially shaky.
Does it resonate? Did it work?
Seems like it did. Arm & Hammer liquid detergent, its consumption grew 1.9%. Now remember, the category overall was flat.
So they grew against the market trend.
Precisely. They took share, pushed their market share up to 15%.
Okay, share is good. But what really caught my eye was the household penetration number. They said it hit an all-time high of 30%.
Yeah, 30%. That's huge.
What's the significance of that? Does that mean they're actually pulling in new customers, not just getting existing ones to buy more?
That's exactly what it suggests. They're grabbing households who maybe use other brands before or maybe use those expensive pods and have now switched. They see Arm & Hammer as that trusted value option.
And that feels more sustainable than just temporary promotion-driven bumps.
Right. It's expanding the actual user base and doing it without massive increases in promotional spending, which shows they still have some pricing power, even at the value end. That's real resilience in a staple category.
Okay, so Arm & Hammer holds down the value for it. Makes sense. But 1.9% growth there doesn't get you to 3.4% overall organic growth. They needed power on the premium side, too.
Absolutely. And this is the other side of that divided consumer coin.
How so? If people are pinching pennies on laundry, why spend more on other things?
Because it's not about pinching pennies everywhere. It's about priorities. The sources really back this up. People will pay a premium, even now, if a product solves a specific, noticeable problem.
The problem-solution brands, as they call them.
Exactly. Things related to health, self-care, functional beauty, stuff that fixes something visible or makes you feel tangibly better. Budgets might be tight, but people carve out room for that.
Okay, let's look at examples. Touchland, the hand sanitizer. That was a recent acquisition, right? July 2025.
Correct. Closed in July, and it's already hitting it out of the park, apparently.
How so?
Fastest growing hand sanitizer brand in the U.S. Number 2 overall now. Q3 consumption was up double digits, beat their own initial forecasts.
What's the strategy there? Is it everywhere?
No, and that's the interesting part. It's a very focused distribution. Over 90% of its sales are coming from just 3 retailers: Sephora, Ulta, and Amazon.
Hmm. Keeping it premium, keeping it kind of exclusive feeling.
Deliberately, they're building that brand cachet first.
But isn't that leaving money on the table? If it's so popular, why not push it into Target or Walmart?
But look at the penetration numbers again. Touchland's household penetration, just under 7%. The category average for hand sanitizer, 42%.
Okay, wow, that's a huge gap.
Massive runway. They can grow efficiently just by reaching more people within those existing premium channels first. Build the equity, build the loyalty, then think about going mass. Go too broad too soon, and you dilute that special feel.
Right, that measured approach makes sense. Okay, similar story with TheraBreath mouthwash.
Very similar dynamic. TheraBreath consumption grew 17% in Q3. 17.
While the overall mouthwash category was down.
Down, yeah. So huge outperformance. It's the number 2 brand holding almost 22% share.
But the penetration must be low again.
You guessed it, only 11% household penetration. The category average is 65%.
So same logic.
Yeah.
Huge potential just getting it to average levels.
Exactly. It shows they have incredibly loyal users who love that specific, less harsh taste profile. But there are tons of people who use mouthwash who haven't tried it yet. 5 times the current user base, potentially.
And they're trying to leverage that loyalty, aren't they? Moving into toothpaste.
Precisely. Smart adjacency move. They tested a new toothpaste line online in Q3, focused on healthy gums, deep cleaning, whitening, things their loyal users likely care about.
Based on that distinctive TheraBreath experience.
Right. Full retail launch is planned for January 2026. It's not random. It's capturing more spend from people who already trust the brand and its unique proposition.
And this appetite for specific fixes also powers the Hero acne brand, I suppose?
Absolutely. Hero keeps outpacing the category. 5.2% consumption growth in Q3, while the overall acne market was flat. Still the number 1 brand, 23.6% share.
Same pattern. Solving a visible problem people will pay for.
Definitely. And you guessed it, penetration story again. Heroes at 9% penetration, the category average, 28%.
Still lots of room to grow there. Management thinks it's because they feel newer, fresher than older brands.
Yeah, they're capturing that younger, maybe more social media influenced consumer who wants targeted solutions, not just a generic face wash.
Okay, and one last bit of innovation before we hit the financials also fits this premium problem-solving idea, Trojan Joked.
Right, the greatest of all Trojan. It's a non-latex condom. The key is this patent-pending material, Ultraflex, designed for better heat transfer.
So, addressing a specific complaint or need for non-latex users.
Exactly. A niche, maybe, but likely a high-margin niche. It shows R&D is focused on premium improvements, not just tinkering with the basics.
Okay, shifting gears to strategy and finance. Growth isn't just about new stuff. It's also about cutting loose what doesn't fit. They announced some divestitures earlier in the year.
Yes, getting rid of Flawless, Spin Brush, and the Waterpik showerhead business. That was about, $170 million in sales last year?
Seems like a lot to just cut. Why do that?
Strategic focus, pure and simple. Those businesses might make money, but they're likely lower margin, maybe more complex to manage. They don't fit the core strategy.
They aren't Arm and Hammer value staples, and they aren't hero-style premium problem solvers.
Exactly. They're kind of in the middle. Selling them frees up management time, resources, capital. Expected to be done by early 2026, lets them double down on the winners.
And they're also reviewing the vitamin business. Vitafusion, Lil Critters, that part of the portfolio is shrinking.
Yeah, the VMS, vitamins, mineral supplements business is having a tough time. Declining sales.
Why are vitamins struggling when these other premium health items are booming?
It's gotten very crowded. Lots of new brands, but also, crucially, really strong private label growth.
So people trust the store brand for basic vitamin C, but maybe not for specialized acne patches.
That seems to be the dynamic. Vitamins are becoming more commoditized, so the company's looking at everything.
Okay.
Fixing the supply chain, finding a partner, or just selling it off. They expect a decision by year-end.
Given the other divestitures, selling seems like a real possibility.
You'd have to think so. It feels like a portfolio cleanup to really sharpen the focus.
And the strong Q3 results give them the firepower to reinvest, right? They boosted their marketing spend guidance.
Yeah, that's a bullish sign. They're now planning to spend over 11% of sales on marketing. When results beat expectations and you plow that extra profit back into marketing.
It shows confidence. You believe you can keep the momentum going.
Absolutely. They're funding growth into 2026, especially for those premium brands that respond well to marketing.
And speaking of execution, they had some good news on the tariff front. That's been a headache for everyone.
Huge win there, actually. Shows smart operational management. They've actively worked on shifting production, finding new sources.
And the result?
They cut their expected tariff costs significantly. What they thought would be a $60 million hit over 12 months back in August, they've now got it down to around $25 million.
Wow, cutting it by more than half. That's impressive supply chain work.
Definitely frees up cash and reduces uncertainty.
So cash, how are they deploying it? Capital allocation focus.
Still doing both, it seems. Returning cash to shareholders, $600 million in buyback so far this year, but also keeping their eyes open for more M&A.
Any hints on what kind of deals they're looking for?
Yeah, they specifically mentioned focusing on functional beauty, not pure beauty.
Fix the pattern again.
Yeah.
Problem solution. Things that do something specific.
Right, and not just basic cosmetics, which can be trend-driven and lower margin. They want brands like Hero or TheraBreath that solve a clear need.
Okay, so strong Q3, smart portfolio moves, investing for the future, leads to a better outlook for the full year.
Correct. They raised the guidance. Adjusted EPS now expected around $3.49, and cash flow from operations bumped up too, from $1.1 billion to about $1.2 billion.
A good momentum. But they're guiding Q4 organic growth to slow down, only 1.5%. Why the caution?
Two main reasons, both kind of temporary quirks. First, Q4 last year had this weird spike because of a port strike.
Oh, right. People panic bought, pantry loaded.
Exactly. Category growth jumped like 11% in 1 week. It was artificial. So they're comparing against that massive unrepeatable number this year. Makes the comparison look tough.
Okay, that makes sense. What's the second reason?
The second is that Q4 is just seasonally a bigger quarter for that VMS business, the vitamins.
Which is declining.
Right. So even if the premium brands are still growing fast, the larger weight of the declining vitamin business in Q4 pulls down the overall average organic growth number.
Got it. So temporary headwinds affecting the Q4 number specifically doesn't necessarily mean the underlying strength is gone.
Not at all. And internationally, things still look very strong. Q3 international growth was 8.4% reported, 7.7% organic, led by Hero, TheraBreath, Batiste. The premium stuff is working globally too.
So when you pull it all together, what's the main takeaway from this deep dive?
I think it's the clarity of their strategy in this tricky environment. They aren't just chasing growth everywhere. They have this very clear dual approach.
Anchor the business with trusted value staples like Arm Hammer for the price-conscious consumer.
Exactly. Secure that base. And then pour resources into these agile, high-potential premium brands, Hero, TheraBreath, Touchland, that solve specific problems people are willing to pay for.
It really is a masterclass in navigating this fragmented consumer landscape.
It really is.
Which brings us to the final thought for you, the listener. We see this clear split, don't we? Consumers trading up for very specific health, wellness, personal care solutions, but trading down hard on basic household stuff. So if the economy keeps getting tighter, which side of that equation proves more resilient? Is it the Arm & Hammer Value Foundation or the Touchland Premium Innovation?
Mm-hmm.
And what does that tell us about the next wave of consumer brands poised to break through? Something to chew on.
An excellent question. Really forces you to think about consumer spending not just as up or down, but as shifting priorities. Well, thanks for joining us on this deep dive.
We'll catch you on the next one.